Gold at all-time highs. Today we'll break down the price action of the 15th of September 2025. We'll go step by step, candle by candle, analyzing overnight and regular DR session probabilities, key structural points, the momentum candle at the regular hours open that gave valuable information, and the confluences that created high probability trade opportunities. By the end, you'll see how the DR strategy allows you to anticipate range expansion with confidence, while others get lost in the noise. At 4 a.m. New York time, the overnight session closes. Let's read what the market gave us. First, the DR box color. It's green. That means the closing price is higher than the open, a signal of strength. Statistically, that alone gives you about a 70% probability of seeing a long confirmation later, defined by a 5-minute close outside the range. But that's just the beginning. The aftermarket session lows are respected. The DR upside model remains intact. Measuring lowest to highest 5-minute closes within the first hour, each range expands its previous DR, confirming a DR range expansion model. Together, these models paint one message: high probability for upside continuation. And that statement remains valid unless the overnight session violates the aftermarket lows or flips into a confirmed short. As a DR trader, your job is to prepare beforehand, and that means adding confluences. Inside the range, there are two open magnetic volume imbalances, untouched and waiting to be rebalanced. These levels act like magnets. Two intraday gap imbalances are also present. Notice one sits outside the range. Why keep it marked? Because price can wick just below the DR low, snap back inside, and then rally higher, confirming longs. If that happens, the upside model breaks, but the range expansion model stays intact. That's an important information most traders miss. And the upper gap imbalance? Right after the overnight open, price dipped into it and then ripped higher, leaving fresh open imbalances. That's strength. Zooming out. Extend previous DR highs and lows into the current session. These levels matter. They're part of the algorithm and they guide decision making. So before any confirmation candle, you already have a bullish structure supported by models and imbalances. Half an hour later, the confirmation comes to the long side as probabilities suggested. The minimum target is set 1 standard deviation in a range expansion model. 20 minutes later, price retraces into the DR, rejects 2 previous session levels plus the recent aftermarket high. That's a valid trade setup. Stop loss below the range mid and the high of a previous DR level. Potential reward 3R. This trade gets stopped out, and that's okay because probabilities don't guarantee outcome. What matters is staying consistent. At this point, nothing's broken. Upside probabilities are still intact. Reanalyze. What's new? During the decline, price left another open magnetic volume imbalance. Now you've got 2 below and 1 above, creating a perfect setup environment. That's your retirement setup, textbook. Targeting 1 SD gives you 4R potential. And notice the bigger picture. The previous day's RDR session also left open imbalances, further supporting upside. Price rallies, makes a new high, pulls back, rejects the same levels again, and by session close, even if you'd moved your stop to break even, you locked in profits from a high probability play. 2 attempts, 1 loss, 1 big win. Net result plus 3R or more depending on management. That's professional trading. Now let's fast forward to the regular trading hours open at 9:30 a.m. Zooming out, what do we see? Gold's been in a strong uptrend for weeks. The best setups naturally form in that direction. For new highs, price must clear several previous DR levels. Highlight them. The model constellation hasn't changed. Upside intact, range expansion likely. And the next 10 minutes confirm it. Each DR expands the last. But the real clue? A massive candle. It leaves an open volume imbalance, breaks through previous DR levels, and signals absolute strength with that. At 10:30, the regular DR range closes, green box again, around 70% probability of long confirmation. Add to that a retracement into previous DR levels plus an open imbalance aligned with the opening price followed by rejection, confluence stacking up. By 11 a.m., then the confirmation happens. A long signal. And not just any, a strong one, backed by momentum through key DR levels and perfect rejections. The confirmation candle itself leaves open imbalances above the range. Price then tests the DR high multiple times, offering several entry points with the obvious target of 1 standard deviations to the upside. So what did gold give us on September 15th? Multiple opportunities to apply DR basics with confidence. A losing trade that was quickly balanced by a textbook winning retirement setup. And a regular session that confirmed with precision, offering multiple high probability long entries. This is why I keep repeating, trading with DR basics is like playing chess with the market. You're not reacting blindly, you're anticipating, preparing, and executing with probabilities on your side. And the best part? Everything I just showed you is achievable with the free lessons here on my channel. If you want to go deeper into advanced calculations and the finer details that separate consistent traders from inconsistent ones, that's exactly what my M7DR Academy was built for. But whether you stick to the free content or join me inside the Academy, remember, no other strategy offers this kind of statistical clarity. Master the DR basics and you'll see the market with completely different eyes. Have a good trading week and I hope to see you in the next video. We're gonna take on the world.